Do you enjoy taking a little risk in your life? Then an adjustable rate mortgage or an ARM might be the home loan for you. A fixed rate mortgage's interest rate remains the same over the whole life of the loan, but the interest rate on an ARM periodically adjusts after its initial fixed rate period ends. That means the interest rate and your monthly payments could go up or down. Lenders generally charge lower initial interest rates for adjustable rate mortgages than they do for fixed rate loans, so at first an ARM might be easier on your bank account than a fixed rate mortgage for the same amount. An ARM might also allow you to qualify for a larger loan because lenders sometimes qualify based on current income and the first year's payments. And if mortgage interest rates stay steady or decline, an adjustable rate mortgage could cost less than a fixed rate mortgage over a long period of time. Remember that if interest rates stay steady or decline, you could save money over a long period of time. But if rates go up, the rate on your ARM will follow, and so will bigger monthly payments. It's a trade-off. With an ARM, you get a lower interest rate up front, but you assume more risk down the road. Is it worth it? That can depend on the answers to a few basic questions like, how long do you plan to own this home? If you plan to sell before the ARM's rate starts to adjust, higher interest rates won't be a concern. Is your income likely to go up enough to cover higher mortgage payments? Will you be taking on any other sizable debt like college tuition or a new car in the near future? If you decide to look seriously at an adjustable rate mortgage, here are some of the questions you will want to have lenders answer. 1. What is the fully indexed interest rate on the loan? The fully indexed rate is what you are going to have to pay, and it's more than just the interest rate. It includes a margin that lenders add to the interest rate index. The margin generally runs between 2 and 3 percentage points and is part of the cost of doing business with the lender. So to calculate your real monthly interest rate costs, you will need to know two things: the amount of the lender's margin, which will be stated in your contract, and which interest rate index will be used to calculate the loan's interest rate. There are many interest rate indices, among them the treasury constant maturities, 1 year, and LIBOR. You can easily track the different interest rate indices in the newspaper or on the internet. 2. How long does the initial fixed rate period last? Depending on the loan, you can enjoy the lower initial interest rate anywhere from 1 month to several years. 3. After the fixed rate period ends, how frequently will the mortgage rate be adjusted? The longer the intervals between adjustments, the easier it will be to plan your finances. 4. What limits or caps are placed on the interest rate adjustments? These are the maximum amounts the interest rate can go up or down each time the rate is adjusted. Be sure to have the lender run a worst-case scenario for you. 5. There can also be limits on the maximum percentage increases and decreases in your monthly payments, so find out what those are too. 6. Is the loan convertible to a fixed rate loan? Is there a cost to convert? 7. Is there a prepayment penalty if you sell your home and pay off the loan early? Adjustable rate mortgages lose a lot of their appeal when interest rates are low, and you can get a good deal on a fixed rate mortgage. Still, it's a good idea to know something about them so you can take advantage of one if interest rates start moving up, and they always seem to.